Are you prepared for tax opportunities that disappear at year end? Because the truth is, if you wait until January to start thinking about your taxes, you're already too late. The most powerful tax strategies exist only until December 31st. And when the year ends, so do the opportunities. Today, I'm going to show you the steps that you should be taking right now before year end to reduce your tax burden for 2025. These are real practical strategies that you can save real money. I'm Michael Malachi, CPA at Pink Harbor CPA, and let's walk through the most important year-end actions that you should focus on right now. Tip number 1, maximize retirement contributions. Tax advantage retirement accounts remain one of the simplest and most effective ways to push down your taxable income. If you're an employee, look at your 401k, your 403b, or similar plans. Increasing options, the contributions during your final pay periods can immediately lower down your taxable wages for year end. For self-employed individuals, the solo 401k offers far more flexibility and higher contribution limits than traditional IRAs or SEP IRAs. Review your year-end date totals, calculate how much room you have left, and adjust payroll deductions or make up lump sum contributions if your plan allows it. This works best when done early enough for your payroll processing team to apply changes before year end, so do not wait until the last pay cycle. Tip number 2, the Backdoor Roth or Mega Backdoor Roth. High income earners who cannot contribute directly to a Roth IRA often overlook one of the most valuable long-term tax strategies, the Backdoor Roth. You can contribute to a traditional IRA as a non-deductible contribution and convert it to a Roth IRA shortly afterward. As long as you don't have other pre-tax IRA balances, this is usually a smooth process. The Mega Backdoor Roth takes this much further. If your employer or plan allows an after-tax contributions and in-plan conversions, you could potentially move tens of thousands of dollars into the Roth space each year. This is a tax-free growth for life. These strategies require planning before year end because contribution timing, payroll configuration, and pro rata rule can all impact the outcome. If you find this information helpful, take a second to like the video and leave a comment. It really helps the YouTube algorithm push this content to more people who need it, just like you. Tip number 3, tax loss harvesting. Now is the time to take a look at your taxable brokerage accounts. If you have investments currently in a loss position, selling them before year end allows you to offset capital gains and potentially reduce your taxable income by up to an additional $3,000 against your ordinary income. Pay attention to the wash rule. If you sell a security at a loss and buy the same substantially identical security within 30 days before or after the sale, this loss can be disallowed. To avoid this, consider switching to a similar but not identical investment, such as an alternate ETF in the same sector. This is also a good time to review revenue gains. If you're in a lower tax bracket, you may qualify for the 0% long-term capital gains rate, and harvesting gains could be a smart move. Tip number 4, accelerate deductions and defer income. Business owners in particular can benefit from timing strategies. If you expect 2026 to be similar or lower income, deferring end-of-year billing into the following year can reduce down current year taxable income. At the same time, accelerating expenses such as purchasing the supplies, paying vendors early, or prepaying deductible items can further reduce this year's tax burden. Individuals can also benefit. If you are close to the itemized deduction threshold, prepaying deductible expenses such as taxes or charitable gifts may push you over the limit and allow you to itemize instead of taking the standard deduction. Timing is key because most of these opportunities end entirely on December 31st. Tip number 4, maximize health savings account contributions. An HSA is one of the most powerful tax shelters available. Contributions are tax deductible, the funds grow tax-free, and withdrawals for qualified medical expenses are also tax-free. For individuals with qualifying high deductible health plans, maximizing your HSA contributions before the year end can significantly reduce down your taxable income. Many people underestimate the long-term value of the HSA. Used strategically, it can function as a secondary retirement account because medical expenses in retirement are nearly guaranteed. Before we keep going, if you want your taxes handled by an expert, use the links in the show notes to schedule an appointment online or call us at 856-226-9524. Don't go anywhere. There's more that you need to know, and the next strategy is just as important. Tip number 6. Increase charitable contributions. For individuals who itemize deductions, charitable giving is one of the most flexible ways to reduce down your taxable income. You can donate cash, appreciated securities, or use a donor-advised fund. Donating appreciated investments that you can have held for more than 1 year can give you immediate deduction, while also avoiding the capital gains tax that you would have paid if you sold the investment yourself. If you know you want to make charitable contributions in upcoming years, but want a deduction now, funding a donor-advised fund before December 31st lets you take care of that deduction immediately while spreading your charitable gifts over time. Double win. Tip number 7. Using flexible spending account balances before the deadlines. FSAs are different from HSAs. They usually operate under a use it or lose it rule, where unused funds expire at year end. Some employers allow a small rollover or a grace period, but you cannot assume that applies to you. Check your FSA balances now. Use your FSA funds on qualifying medical, dental, vision, or dependent care expenses. This is money that you have already earned, and losing it due to an inactivity is one of the most preventable mistakes taxpayers make each year. Tip number 8. Review your withholding to avoid penalties. Many taxpayers are surprised to learn that the IRS can charge underpayment penalties, even if the full amount is paid by April. What matters is whether you paid it consistently through the year and met certain safe harbor thresholds. If your income changed this year, or you have an unexpected income, review your tax withholding now. You may need to increase your withholding on your final paychecks or make an estimated payment by January 15th. Correcting this in December can prevent penalties that would have otherwise appeared on your tax return. Now, just one moment before we dive into the next part. Have you liked this video yet or subscribed to the channel? Do you know how long it takes to make this film edits things? Come on, do me a solid, please. Like the channel, subscribe, leave a comment below. It really helps me more than you think. Tip number 9. Make a 529 plan contributions. If you have children or grandchildren and want to save for their education, 529 plans are one of the most effective tools available. Many states offer tax deductions or credits for contributions made before year end. Even in states that do not offer a deduction, contributing early gives your investments more time to grow tax-free. Year-end planning is a great time to evaluate your college savings progress and make contributions while you still have time to claim the applicable benefits for 2025. Tip number 10. This is your final opportunity to take advantage of 25C or 25D energy efficiency tax credits. Sections 25C and 25D allow tax credits for qualifying home improvements, including insulation, windows, doors, heat pumps, solar panels, and more. These credits can reduce down your tax liability dollar for dollar, and some are substantial. The rules for the specific credits are specific, and projects must be placed in service before December 31 to claim the credit for the year end. If you're in the middle of upgrading your home's energy efficiency, confirm which improvements qualify, gather documentation, and ensure installation is completed on time by December 31st. In closing, these 10 strategies represent some of the most effective ways to reduce down your tax burden for 2025, but they are only available if you act before December 31st. The most common mistake that people make is assuming that the problem can be fixed in March or April when they're preparing their return. At that point, nearly all of the planning opportunities have already disappeared. I'm Michael Malach with Pink Harbor CPA. If you're needing help implementing these strategies or understanding how they apply to your situation, reach out. If you want your taxes handled by an expert, use the links in the show notes to schedule an appointment online, or call us directly at 856-226-9524.